I'm going to pass the mic. You guys have a mic. We'll share, Tristan, you guys can share. I would like for you to introduce yourselves and talk a little bit about who you are, and also kind of, we have some questions, you got them ahead of time, but a little bit about kind of what your profile is, what you typically work on within your role, okay?
Yeah. So I'm Tristan. I am the branch manager of the downtown US Bank branch, just down the street on Market Street. And I've been with US Bank for 10 years. I primarily work with startup businesses, helping them establish a bank account and maybe a business credit card and that kind of piece. And then I pass off to my business partners. We have a small business specialist that I work with, and she does businesses that are revenue of $500,000 up to $2.5 million. And then Mike Seidel, who's here with us tonight, he helps business clients with annual revenue of $2.5 million up to $50 million. So that's kind of how that works. But we're working with small business clients all the time to help them in their business and help them grow.
So I'm a commercial lender as well for the credit union, Sierra Central. Our territory is pretty much Northern California, except the coast, and pretty much Wairika to Sac, and maybe a little bit further south. But so we do focus instead of revenue, we focus on things a little bit differently. We can do some select startups. It really just depends on what the assets are and global income versus the business income. So while we do look at projections, we have a little bit more flexibility in the fact that we can use some global income and potential other investment property to cash out and let you purchase whatever startup business or idea you have. Really, we go from about 50,000 all the way up to a little over 4 million. Sometimes we can push it and maybe go like 4.2-ish, but that's kind of where my limitations are. So we generally like businesses that have been around for at least 3 years and have 3 tax returns. But again, every rule is meant to be broken. It really just depends on that business, right? So.
Thank you. Okay. So I'm the person that you would come to talk to when you don't know which bank you're supposed to go to first, okay? Outside of the SBDC, I have other businesses as well, but with the SBDC, I help businesses navigate lending and access to capital. I live in Fortuna, which is in Humboldt County, but I service a 36-county territory, so everywhere north of the Bay. And within that territory, I have about 400 clients that I'm helping to access capital. And the way that I'm able to do that is I have to know all of the different regional lenders, okay? There's different levels to lending. For the people that haven't been in business 2 years, 3 years, you don't have those historical tax returns, we're gonna have to go to a CDFI or a community-based lender, or maybe even stack it another way creatively until we're ready to go to these guys, right? So these kind of folks, they pass business to me all the time so I can keep their customers happy, and when it's time for them to go back to their bank or their lender, then we take them back to them. So that's what I do.
Awesome. There's a couple of groups of other people's money as well that kind of stand in the gap between starting up and needing funds and after spending a significant amount of your own resources. If you're in the gap between that point in time and being fundable by a bank or an institution, friends and family or angel capital can come into the play. Those are, friends and family to some degree is a little more straightforward and less nuanced than even angel. But throughout the year at Startup Reading, we talk about different forms of, those types of investors. We have some institutional investors, and then obviously SBDC can advise where you might need to go next. So just so you know, there's a gap, right? There's something in the middle between having an idea, spending your own money, getting your friends and family to invest, and then maybe approaching an angel investment group for that startup investment and capital. Yeah.
Can I hop in on that? And so when I help people navigate lending, sometimes it is lending from your mom, and it doesn't matter to me where the capital comes from, as long as your business gets funded and we're hitting the plans that you guys set. So I help people package up pitch decks to give to their aunt, and so we can help throughout that where there is that kind of gap and where you're expected to put in everything yourself, we can help in that gap too.
Okay, also in grant funding. Sorry, that was on my list of things too. Grant funding is a little bit outside of, definitely outside of what we're going to talk about tonight, but a little bit outside of kind of what we typically see in the normal kind of course of business, but we're seeing it more and more in specific industries. But California does offer some grant funding programs, and it's real specific to industry. And so also, if you're here tonight wondering what other kinds of people's money you can use, there might be an opportunity to look for some grant funding as well. So just keep that in the back of your mind. Especially, I know we have a lot of nonprofits, or a few anyway, in the room, and typically that grant funding can stand in place of traditional financing. The other thing to say about grant funding is that it really does, it's kind of unrestricted capital, and you put it in your books as revenue, and then that signals to other investors that you've raised some money, and that you are a viable kind of business. So, okay, so those are kind of more educational disclaimer, and now I'm going to get to the questions. Okay, question one. And this is really about what lenders actually look at, right? And so you've heard some of the profiles, and you hear it's negotiable, and we really just need to take a look at the business. But when a founder comes into your office looking for funding, what are the first things that you immediately evaluate?
So we're looking at cash flow. So how much money is coming in and going out of the business. The amount of time in business can be important. 2 or 3 years for lending typically, but we are an SBA lender at US Bank. And so if you don't have that time in business, we can look at some SBA options. And what's great about our SBA program is that we don't sell those loans off. We actually keep them in-house. So that is something unique for us. And then credit, and your personal credit is important, as well as business credit. So when you open your business and you start your business, US Bank can do a credit card for you on day 0 before you've made a single dollar based on your personal credit. So I would strongly recommend, if you don't have a credit established, that you get that done right away.
A lot of good points. So we always look at type of business, time in business, revenue. While we do look at the revenue over 3 years, we mainly pick apart the last year. So that's very important to us anyways at the credit union. As far as credit cards go, we're a little bit different. 1-year tax returns and personal credit score is what we'll go off of, and we can issue anything from $1,000 to $50,000 in a credit card. So I think maybe some other things that we look at while we're evaluating that business is how much money they brought to the table, how long they've been in business, and then if their ask is greater than maybe our appetite for that risk, we'll partner up with an economic development council like SCED or maybe a different type of economic development council that does SBA community advantage loans or something like that. So we're a little more flexible, but really depends on cash flow.
I want to dig in. Don't pass that mic quite yet, because I want to dig in on, you said types of business. So I think I'm going to put you on the spot a little bit. Talk about what types of businesses are appealing and which ones are harder to look at.
Oh, geez. So that the typical risk profile for lenders, I mean, I think everybody up here would agree. If you're a restaurant, bar, coffee shop, even some retail doors, it's going to be a lot harder to get lending, especially at your ask or at a desired rate, than if you were a professional. So even if you're a startup or doctor or dentist, or you've been in business for a decade or two, they just have a lower risk profile, and so you get better terms, and it's just easier to lend to a professional that way. Hotels, motels, those are usually, if ran right, they're usually fairly easy, even though they're a little riskier. Gas stations, maybe not as much of an appetite because of the EPA issues, or even some mechanic shops, depending on, if there were bad environmentals in the past, oil spills or something. We love real estate, apartment complexes, whether they're or just commercials with buildings with roll-up doors. Yeah, those never seem to go out of style. We love that type of risk.
Sounds good. Thanks for digging in on that. Okay, Eric, same question.
What was the question? What do we first look at?
When somebody comes into your office,
Yeah.
what are the first things you're immediately evaluating?
The first thing, do you have a business plan? Okay. Yeah, I have a plan. Well, where is it? Well, it's in my head. Yeah. Okay. Well, we need to be able to communicate that to a lender who we're going to ask to give us money. So, let's start working on that. But after my first meeting, it's always business plan. You don't have it, I can help you start one. Personal financial statement, any lender is going to require that. And so I send over the SBA form of that. Most lenders just have a different copy of that in their application. And so I look at that first because we talked about global cash flow. And as a startup, that's basically how you're being lent to. They're not just saying, oh, wow, your idea is great. They're also like, oh, wow, but you also have this secondary income, which is necessary to cover the debt that you want to service, right? Or I might see on there, okay, you own 3 houses and you have a ton of equity here. It's going to be cheaper for you to take equity out of your home and use that for your business than it is to start the business loan cycle, right? So, like I said before, I want businesses to succeed, and I want to give them access to capital, and it doesn't matter who it comes from for me, as long as it's hitting it right for the business owner.
Thank you.
Yep.
Okay, to my staff in the back, it's really hot up here. And I think everybody, if I'm looking around the room, everybody's looking a little warm.
Thank you.
Well, and that.
Well, that too, but
Slipped out of my hand.
okay, thank you. Okay, so this is a little bit along the same lines, and so if you can pass the mic if you've already covered it or you feel you've already covered it. But what separates a business that feels finance ready from one that is clearly not? Eric, we'll start with you this time.
Yeah, the easiest, and the thing that jumps to my mind first when you say that is bookkeeping. What are you doing to keep your books, right? We have bookkeeping business here that came tonight. Most business owners, and I'll tell you, I started an insurance agency about 15 years ago, and the first couple of years, it's just me. My books I added up my deposits at the end of the year, and I subtracted what I paid out from my check card, and that was my books, right? 15 years ago. That doesn't work. You can't just tell a bank, like, yeah, I'm very profitable. So having your bookkeeping and having an idea and knowing what stage of business you're in and what the next stage is, right? Because what these guys they'll tell you, but what they didn't tell you is that, like, as soon as you walk in and start talking to them, they're underwriting you in their head, okay? Every little question they ask you is them underwriting your character, all right? So if you don't know the answers to the questions that may be simple questions as far as financing goes, they're going to make a mental note. I don't know about that, you know? Are these guys as prepared as they need to be? So I think that is really important first stuff to have after a meeting.
Yeah, I was at a conversation with, when I was a founder, I was actually in Silicon Valley, and the first time I get asked what my burn rate was, I didn't even know what that was. So I had to go back and do some research and know what my burn rate was. Yeah, we just keep having conversations and learning new things.
I didn't know what a debt service coverage ratio was 2 years ago, okay? It's like one of the biggest things in lending. So.
Yep.
So I agree with all that. That's all very important. I think maybe I'm always looking at character and capacity. My first 5 questions cover that, whether the customer knows it or not. I don't know that I can add anything else. I think you guys have pretty much said it, yeah.
Just really how comfortable you are with the financials is really important. So making sure that you really understand that too, so that you're not just going, here's my P&L and balance sheet and figure it out. Like, do you understand what is actually on those papers? And there are resources you can talk to, including a banker if you wanted to sit down. They can help with that.
Yeah, so the resources that you can talk to that provide technical assistance to help fill out these loan applications and get everything packaged, that's me. That's us.
Yeah.
That's what we do. That's what we help you do. Yeah, that's it.
And Startup Reading will help you locally and kind of even regionally get connected to those resource partners like SBDC, or we typically will know the profile of all the different banks, maybe not as well as the SBDC sometimes, but when there's a match, we'll refer you out to, if there's more than one match, to the folks that you would have a match with, or maybe the one, if there's one that you would have a match with in terms of what that lender's profile is. So any technical assistance you need, you can come to Startup Reading, and then we can refer you out to the resource partner that provides that technical assistance. But I do want to underscore the ability to understand your own financial statements. I work with people at many different levels in a lot of different industries. And people that have been in business for a very long time who really, it's just like revenue minus expenses. And that's been okay for as long as they've been in business. But at the point that they need financing or the point that they want to sell their business, you really, really have to have a handle on how all that flows. And you have to be able to articulate and have, I think, a level of comfort around the financials.
If I could add, that's very true. A lot of times, depending on if you're a startup, your growth or expansion phase of your business, we'll send you over to, or at least I will refer you over to the SBDC or the Women's Business Center, just kind of depending on where you need help, or a CDC, Economic Development Council. But sometimes you got to start there because you don't have that business plan, the projections, in order for our underwriting to even take you seriously.
You mentioned the CDC. We would typically have somebody from the CDC at this panel. Can you talk a little bit about, on behalf of what the work that the CDC does? Their local person for the CDC has actually retired.
Yeah.
And so we don't have somebody in Reading right now for CDC, but
he lives in Sacramento.
Yeah, and the CDC, I think, amongst all of the partners is probably can get the most creative.
Yeah. So it's interesting because there's different names and acronyms for these lenders. CDFI is Community Development Financial Institution, something like that. That's what CDC, Small Business Finance, is. They just name themselves CDC for some reason. But yeah, so they have a part to play. Like the CDFI lender has a part to play for startups that haven't been in business a long time. They don't have a huge down payment, because that's going to go to a little group of 8 people, and they're going to look at each one of those things, and they're going to vote on it and make a decision on it. And they're also community members, okay? The CDC, where they really come in and help, is just smaller loans, smaller, fast SBA loans. Stacy Sanchez was the person up here. She did it all throughout California for 20 plus years, right? Mm-hmm. She's retired. I'm still close with her. We still go out to eat when I'm here visiting. Mike Dang is her predecessor, based out of Sacramento. He writes SBA loans up to $350,000 for an SBA Express. I don't know if that's even where you wanted me to go with that.
No, I think it's important because when we talk about kind of the institutional lenders and we talk about, the traditional bank financing, there really is a big gap between, I've been in business for less than 2 years, but I've got sales of almost $1 million and I need some capital to get more inventory.
100%.
And so I think there's a gap there that folks in the room should really be aware of, that some of these places like the CDC especially, and SBA especially too, that there's capital available through those programs that don't have the same requirements, as the bank. So yeah, absolutely.
So yeah, those CDFIs and CDCs typically will have SBA products available, and then they'll also maybe have the state loan guarantee products, which is the same thing as an SBA product, but it's administered by the state instead, okay? And all of those things, all they do, I was thinking long and hard on my 3.5-hour drive over here, like, what did I really want you guys to leave here with? An SBA loan or a state loan guarantee product, those things are there to help you because you're not ready for the bank yet, right? That's why they're there. They help you because you don't have to put as much equity into a big purchase right away. Maybe you can only put 10% instead of 20%. And that's all because these organizations are guaranteeing your loan, right? They're not doing anything like flashy for you. You get to make a lower down payment, and they're making the bank more comfortable to lend to you, right? So we have CDFIs, we have CDCs, we have credit unions, conventional banks, we have these online banks, right, that we really want to stay away from. But they all play a different part. We have hard money lenders, right? They'll give you money, they don't care, because if you don't pay them, they'll take your house, right? So like, there's all these different lenders, and I get paid to know who they all are and what they do, so that you can come and ask me that question, and I can help point you in the right direction.
Yeah. Okay, this is the juicy question. What are the top reasons businesses get denied? Go ahead.
Lack of.
You're gonna make me go first.
I think from a startup side, it's lack of secondary income is what I see. A lot of folks come to me and they think that they're going to have the opportunity to get 100% financing, right? The first thing Rebecca said, and Sammy hit on it really good at the venture conference, is you have to have skin in the game, right? I'm working with a client now. She wants to buy a florist, okay? I'm not telling you where it is, whatever. She wants to buy a florist. She has no money, but it's her friend that wants to sell it to her, right? And it's like, we can't get around the fact that you need to have money for a down payment, at least. And on top of that, even a community lender is going to expect you to have some kind of a runway, too. Not everything's going to work out the way you think it's going to in the first 3 to 6 months. So if all the money you don't have, or that you might borrow from friends, family, and fools, if that all goes right to the down payment, then where's your cushion? And the lender's not going to give you money for that business.
Yeah, so cash flow is a huge piece to why we would have declines. You have to prove that you can pay the loan back, and then having credit worthiness. So your personal credit is going to be important in that piece.
Yeah, credit worthiness always an issue if you've got whatever it might be, whether it's child support or bankruptcies. Late pays, slow pays, it all gets looked at. There has to be a really good excuse as to why it's there.
Do you guys have a minimum credit score that you won't go below?
We do. It's not published, but we do. I mean, we'll look at anything in the, we're very comfortable looking at things in the 600s. If it goes below that, I mean, there has to be a really good exception or reason as to why we would want to proceed forward, right? divorce or some other kind of liability may be an issue. We've ran across that before. Some have got turned down. Some have not because their business cash flowed. Maybe if your business cash flows and it's basically bringing in $1.25 versus every dollar that you burn through, then we'll definitely give it the best shot we can. If it's below that, then it might not be something that or any bank is interested in, unless there's a really good reason as to why, you hit $1.01 versus $1.25. So, I don't know, but as far as like turn downs, I think there's a lot of other silly things, like people don't know what their burn rate is. People don't know what their partner's credit is, and then your partner comes in and he's got a 550, and the other partner's got an 840, and you're going, okay, wait a minute, how much does each have invested into this? There's so many different ways to go with it.
I feel like too that there are, in the beginning anyway, there are a lot of people that think that the business is separate from you. That you might think. I think a lot of people think that, if you've struggled with your credit or you've struggled financially on a personal level, that, if the business is separate from that. And I think that's a little bit of a rude awakening when you step up to get financing. I also know too that if, and this is more on the kind of venture capital or angel investment side, is that if you can't talk your mom or dad or aunt or cousin or neighbor into investing in your business, and if you, again, haven't put, skin in the game, that's another kind of thing where in those investment categories, people might say, like, until your mom, who should be your biggest cheerleader, puts in a couple bucks, we want to see that level of commitment. We want to know that you are able to sell this to the people who want you to succeed. So that's another reason why I know sometimes in those environments, people might get turned down. So
I think that a couple other things were really important that got raised there that I want to address is, one bank might be comfortable with credit scores in the 600s, 700s, obviously 800s, right? But the state loan guarantee programs that I'm talking to you about, that lowers that, right? We need to be able to get access to capital to rural business owners, people that don't have the same financial opportunities, right? And so those credit scores go down. One of the CDFIs that I work with, they're called Working Solutions. They'll give you up to $100,000 in working capital if you're a pre-revenue startup. You're going to have to show that you're going to be able to pay it with your spouse's secondary income, yours, whatever, until the business has some proven cash flow. But they've touted that they've funded a business before the business owner's credit score was 480, okay? So having terrible credit sucks. It feels bad as a person. That doesn't feel good. But there's lenders that will talk to you if we can get all the other pieces in order. So you just don't have to be completely turned off if you don't have a 700 credit score.
I want to just kind of flip that over here to our bank credit union lenders. How much do you care about personal kind of finances versus business finances? Obviously, in the scenario that Eric just gave, that it becomes less important when you're working with those lenders. But for you guys, what do you think in there?
So it really just depends on the why. So if you're just really bad with your finances and you're always late, bank repos, or you're always 30, 90 days late, and it's just you not being a good bookkeeper. I mean, there's lots of folks that aren't like doctors and attorneys. They're dealing with clients and patients. They don't have anybody paying their bills regularly. I see that the most. But if you have a good excuse and it's a one-off, going back to that 480, I've gotten, maybe not 480, but I've gotten a low 500 approved with a low 600 husband and wife team that was pulling some cash out of a business. they had a death in the family and some huge medical bills. It was a one-off. We were able to mitigate that and show that that wasn't what their profile was. And so we were able to look past that. Like I said, I guess our job as a lender is to look at the whole picture and then go to our underwriters and sell that story that makes sense. But if I'm trying to sell that story and it comes up that you are habitually 90 days late on a credit card or a car loan, then I can't go to bat for you and say, hey, this is why we should do this. Everything checks, and let's take the risk.
And I just would say, if you are not taking care of your personal finances, what makes you think you're going to take care of your business finances too? So it's an important piece of it, and you do have to have skin in the game. And, it's like, if you have equity in your home and you're not willing to put up your house for this loan or for your business, but you want us to give you a loan, that doesn't really make sense either, right? So you have to have skin in the game.
That's a hard conversation to have with folks. Why should they trust you with their money if you don't trust your own money in it?
We're going to move on to some questions about how to prepare before you need money, but I just want to give folks an opportunity to ask questions about kind of this section. Do we understand, risk profiles? Are folks understanding kind of basic terms here based on what we're talking about? Is it jiving, or are there still questions or gaps that y'all are having in terms of the information? Yeah.
Small question. For I think 2 years, I had my accountant was doing everything with cash basis. Discovered this as it really works. Like you're saying, you should have everything in email. And I started like that. Then we switched over to referral and kind of changed things with assets. Curious, does that also weigh into it?
Does it matter if it's cash or accrual? And if you have a switch, I know that point in time where you switch, does affect some things. Is that something y'all can speak to?
I'm not familiar with what that looks like necessarily, but I would say that's probably one of those things that's a case-by-case basis. So we would want to take a look at what that is, because we are looking, and we might get to that later, we're going to be looking at year over year, financials to know, is the business still making money? Is it growing? And those kinds of things. So that's going to be an important piece, and that might affect that, the way that looks on paper, right?
I think it's just important to communicate with us, and we're already going to have it. Once we see it, we're already going to have a question as to what the switch was. We could probably tell, but if you just let us know so we can tell the underwriter, oh, they switched, this is what the swing is for, it's nothing negative, and then I think that's about it. It's not that big.
Okay, so go ahead, Eric.
This is maybe interesting to other people, it's interesting to me. Are the frontline lenders that are meeting with the entrepreneurs likely to fight for that entrepreneur to get money, or not? What's sort of the incentive structure for that person?
Absolutely. We believe in our clients, and we want to help them get the funding that they need. And it's actually going to answer the next question, but you want to build a relationship with your banker really early on, so that you have that person in your corner to help you when it comes to those pieces, because they're going to fight for you.
Yes, definitely. We definitely fight for our clients, not only because some of us make commission off of it, and we all have a salary, but obviously there's some other incentive on our end. But the bottom line is, like, if we don't believe in you and we don't think it'll work, there's no point in wasting your time or our time. So if I think there's an issue with it, I'll send you over to this gentleman, or I'll send you over to Quentin at the SBDC, or Alex. Yeah, I don't see him here, but got it. So, or Alex from the SBDC down here, or someone from the Women's Business Center, depending on what area you're lacking and that I see you need help with, whether it's business projections or QuickBooks or something else, that you just have to get a handle of before we can move to the next step? So.
This is super easy. The best answer. This is the most fun sales job I've ever had, is being with the SBDC, because I don't charge for my services. So I'm 1,000% fighting for the client, right? And that means that sometimes I rub lenders the wrong way, actually, you know. But it's like my job and my only job and my mission is to help my client attract capital. I don't care about all the politics of banking and all this stuff. I'm going to put the right people in front of them. They can make that decision from there. And it's most likely it's going to be based on a relationship. We say the same thing. Hey, who's your banker? What do you mean you don't know? You need to have a relationship with your banker. You are going to ask them for money at some point.
I also too think it's important to know that if you get declined by one source of funding, that you should let a guy like Eric at the SBDC, or even if you're working with Startup Reading, you should let us know, because again, we get paid to know where decisions are made, how decisions are made, and kind of the basic profile for each bank. And so just a quick story, a local startup actually that's growing pretty rapidly, just said like, oh man, we're gonna have to finance this project ourselves. Our bank doesn't do loans under 50 million. And so I said, like, there are a lot of options.
Mike, where's your phone?
Yeah. And so, so if you're with a bigger, even a bigger bank, US Bank is a very large bank, but decisions are made more at the local level or regional level. But some financial institutions, don't make any decisions locally. And then they just say like, 50 million is as little as we go in this bank, and so it was really interesting because that particular leadership team was really struggling with where to get financing, and we were able to make some recommendations to a few local banks anyway that we knew could make a decision locally and that did loans, under 50 million. And so I think they maybe only needed, I'm going to just say 5 for the sake of this conversation, so just kind of knowing the right profile, I think. So Eric gets paid to know that, we know that. And so if you strike out at one, don't think that, that it's all over and you'll never get any financing anywhere, because there are a lot of options between A and B.
Right. And I feel like a lot of the banks, because I meet with, part of my job is I'm meeting with lenders, I'm driving around and meeting with them every month and learning about how their appetite has changed and who switched from what bank to another bank. That's just kind of how it works in that ecosystem, and I just completely sidetracked myself. So
no worries. Okay, so I'm just going to lead you into this question that you already started with, what you should be doing 6 months to a year before you ever apply for financing. And so Tristan teed it up with begin a relationship, walk into the bank and meet somebody.
Yeah. I mean, that's really it. You start that relationship with your banker and work with them and let them know about your business and what your business goals are. Be really open and transparent about what's happening in your business so that they can help to formulate those plans and help give you guidance down the road. So, yeah.
Yeah, that's all true. Definitely walk in, open an account, and get to know whoever the banker or the lender is. At the credit union, we definitely make exceptions for existing clients over a walk-in off the street or somebody that that's not a client yet. While that can be contingent on a loan, having your ducks in a row and meeting with the SBDC or the Women's Business Center and having the projections and everything done, and all you have to do when you're talking to your banker or your lender, saying, oh, well, you know what, let me call my CPA and get the updated. I only have until the beginning of the year, but I'll get that sent over to you. That says a whole lot versus, oh, what's the projection? I haven't done my taxes yet. They'll be done in October. It's totally, you'll get a lot further if you have your ducks in a row.
Yeah, it's just preparation. The business life lending cycle is 30 to 90 days, and it doesn't start until all of the stuff is turned in. Right, and so if we submit a half completed package, and then we get an email 2 weeks later, hey, I'm still waiting for these tax returns. That time frame didn't start yet, right? And so it's just preparation, just being prepared.
I'm guessing that throughout your careers, you've all seen different forms of financials, different ways people are reporting their finances. I think now, more than any other time in history, there are tools like QuickBooks that are pretty user-friendly, pretty easy. But how important is that clean and kind of high quality financial reporting? If somebody comes in with a napkin or a notebook,
Or a shoebox full of receipts.
or a shoebox full of receipts, and I'm guessing you've probably seen lots of different variations of that. But how important is it to maybe use a tool and have that clean and quality financial reporting?
It's so easy now and affordable. I mean, cover your ears, bookkeeping crew that was in here. So we have referral partnerships with QuickBooks Online and Xero, Xero, right? And so I've had QuickBooks before. I tried Xero because I'm referring them to people. It's so easy and so quick and so much easier than it was even 2 or 3 years ago. And you just need, that is the heartbeat of your business. Like, oh, I don't have any money. Where's my money at? Pull up in the app and look, oh my God, where did this expense come from, So it's the heartbeat of your business. So it's just, and with all of the technology and tools we have available now, there's really no reason not to have good finances.
Yeah, and we're going to tell your story to the underwriter, but the underwriter only cares about the numbers on on those financial forms. So it's important to have it neat and clean.
I will say to your question earlier about cash versus accrual, in QuickBooks it's just one click of a mouse and you can have either. So it's that easy. If your QuickBooks or other program like it is in line and at least somebody touches it once a quarter and inputs everything correctly, then you won't have an issue at all.
And just kind of with the tools also, the banks and the apps and how they integrate with all of those tools, I think make it really easy to track expenses. There's an app for literally everything, for mileage, for travel, and
Pretty soon for oil changes.
corporate vehicle oil changes. Yes. Write that off. But yeah, so I think too, this is something that's easy to do, but also I know that it's easy, especially for folks that are new, right? For new founders, start there, right? Don't start with receipts in a shoebox. Don't start with back of the napkin math. Get your stuff into some sort of record keeping system really early on, because it will make all the difference and save you a lot of time as you get further and further down the road.
Yeah, and making some mistakes on a ledger by not classifying something right, small problem to have versus not having anything in a ledger at all, right? So don't let that hinder you. Somebody can always fix that down the road, or point out that it was labeled incorrectly.
So as we get into financials and talk about, what those actual financials look like, what are some of the red flags you see when you're evaluating companies? What are some of the red flags in financials? Is it coding? Is it writing off expenses, maybe that people are taking liberties in the write-off of expenses? Is that a red flag?
Well, I don't know that I'd say that it's a red flag, but if you're not showing income on your financials, you're not going to get a loan. We have to have income on there. So it's an important piece. It does mean you're probably going to have to pay some taxes. We don't give tax advice, but you have to have some income reported.
So while we can add back a small handful of items like depreciation and interest, you definitely have to show income. And if you're really, really good, or your tax preparer is really, really good at writing everything off, it makes my job as a lender that much harder. And I may have to tell you no and wait for you to do taxes next time in order to show that you have the propensity to repay the loan. Because if you don't, if the business doesn't have the propensity, or your global income, a spouse's secondary income, or your second job doesn't have that ability to cover it, then the answer is no right out of the gate. I don't know.
Yeah, so when I talk to business owners, especially the ones that are just starting, I ask them, there's two different ways we can set up our books. We can set it up to reduce our tax liability, which is what we were just talking about, or we can set them up to prepare for a credit decision. So if you're preparing for a credit decision, then you need to have net income. If you're preparing to sell a business, if your net income has been zero because you didn't want to pay taxes, then your business is worth zero plus the assets, probably, So those are two of the hard conversations to have. It's like, well, yeah, I know you didn't want to pay taxes. I don't either, but I'm not the one preparing for a credit decision right now, and you are, right? Or you're trying to sell your business right now. Well, it needs to be a profitable business, or else nobody's going to be able to borrow money to buy it from you. Then you're restricting yourself just to a cash buyer. So it's just important, and like that's where the planning comes in too. Like, know where you're at, know what you're getting ready for, know what's coming down the road.
And one other thing would just be large discrepancies from year over year in the financials that you can't explain. So if like cash versus accrual, that's something that we can explain, we can understand that. But if there are large discrepancies or differences from year to year to year, that's a tough thing.
It's really interesting because I think this really comes up, especially when entrepreneurs want to buy a house. So young entrepreneurs who have been avoiding taxes for a long time ultimately decide that maybe they want to make a purchase that requires credit. And this is, kind of where you're, depending on how you're setting your business up, that you need to show income in your business because you need a house, and that's a personal, so you need to have some income. And so I've heard this more times than I can count on all my fingers and toes, that when folks want to buy a house is when that kind of shift happens, when they say like, oh, well, yeah, I've got to start reporting income because, I've got to have income to buy a house. So I think, yeah, that's a good point well made, Eric, about like, are you setting things up to, mitigate taxes, or are you setting things up to show income? And sometimes people switch halfway through the process. So we've kind of covered that category. Want to just kind of open it back up to the audience here for questions about, preparing. So as you think about, setting yourself up for before you need money, if you're setting things up for credit decisions and preparing, what questions do you have about that? Go ahead.
I'm never probably going to refer you to a hard money lender, but I might show you that that's maybe the only option right now while we're getting ready to approach a different lender. So they're in my toolkit, but it's definitely not going to be one of the first people that I'm going to. It's like, all right, let's talk to everybody else first. We can't get it. You need the money in 5 days. All right, let's go talk to whoever,
Because my clients, actually, they start businesses and they're starting from scratch.
Yeah.
They don't have it. I'm a nurse, so
Yeah.
I work with women nurses. And so, yes, they have the income from nursing, but some of them are retired from nursing and they want to start businesses. And now the online world is working, so most of them are doing coaching and all that. So I'm not sure how that works in the business world to come for a loan if they're starting to get like coaching and everything, and then they're just retired. And is that a world that you navigate?
I mean, regardless, I'm not a lender, I'm not an underwriter, but if there's still income, it doesn't matter if they're retired or not. Like, if there's still income that's coming in, Social Security, they can look at all that as that's part of your income. And so we didn't really go into it, but like the second most important thing we talked about here today was the debt service coverage ratio. As long as you can cover that, you're good, right? Like, the bank's going to want to know where those funds are coming from, and if they're like continually going to keep coming in. But yeah, you can use all of that.
Well, and I don't want to speak for the banks per se, but I also know that too, like it's got to be part of a business plan, right? Yeah. So you have to show, what you need that money for. Is that for growth, or is that for infrastructure, technology, whatever it is to build the business?
And
I think
is the business set up as a business?
Yeah, exactly.
Right? Is it a sole proprietor? Are you filing, your taxes for that business, or is this just kind of like a side hustle?
Well, and then is it in the same field that they were in before? Because they've already had that time in the industry that they're going into. So if it's in the same industry, that can make it easier from a lending perspective. But there's also a lot we can do on the consumer side that's not business for someone starting up. Personal loans, personal lines, credit cards is another way to kind of leverage, depending on what those borrowing needs are, how much they're really needing to borrow.
Other question?
I've never taken a business loan. Paid everything in cash so far.
Sweet.
I'm thinking of starting another branch of exporting some of American motorhomes to Europe and stuff. So I will do maybe $200,000-$300,000 in cash. Is it cheaper to get a business loan, or is it cheaper just to go and get a home equity loan and just?
The only way to know is to look at the terms all next to each other. That's it.
I'll
Right?
give you my card. You can come see me. We'll have a conversation.
And I also want to plug exporting. So we actually can put you in touch with export experts, because a couple years ago, I'm really going to wear this out. We did Export Expo with export experts up in City of Shasta Lake. And so we've helped talk to Mary, actually here. We've helped Mary and other local companies prepare their businesses for exporting, and it is really complicated and really nuanced, and you will save a lot of time and a lot of money if you set it up the right way ahead of time. So yeah, before you do that, we want you, the Shasta EDC wants you to export, and so does the United States and the World Trade Center, because that's how we grow our economy, right? We grow our economy because you're selling your thing outside of Redding, Shasta County, California, United States. We're growing all of those economies when you sell your thing. And so if you'll come talk to us before you do that, we're going to get you in touch with the right people for exporting. And then I won't get into the banking side of it, but that also becomes very, very nuanced and complicated. And so there's ways to set that up as well. So.
I kind of started it already, just stuck in my own pocket.
Yeah, well, there's a lot of resources too. So, I'm really happy to hear that. But California especially is supporting small business who wants to export. So again, this should be a get each other's numbers, because Mary is exporting, and she actually won a pitch competition through the World Trade Center and got some personal coaching. And all the folks that we had here, and grants, but we also, all the folks that we had here are just a phone call away. So, okay, sorry, side note there, but you had something to say about personal or business?
Right. I think that looking up that avenue is great. You can get some money there. There are certain banks in our industry that don't mind or that like exporting and lending. You'll have to talk to one of these folks to figure out who they are in your market. Most definitely they're going to be in Sac or the Bay or San Jose, but I'm not sure about U.S. Bank. Maybe check with them first. They might. And then as far as the other lendings, you definitely go and put them side by side and talk to your CPA or whoever does your taxes to find out which has the best tax benefit or worst tax benefit for you. Because while the cheapest may be a home equity line, it may not be the best tax benefit depending on how you file. So you really need to know both sides of it before you jump into a commercial or a home equity line.
Well, and I was going to say this earlier and I missed it, but it's when you are looking for a bank, look for a bank that's interested in the industry that you're working in or the things that you're working in. That can be really important. So making sure that because some banks don't do well in certain fields or certain industries. So and some do better than others.
Yano, please.
At Venture Conference, one of the speakers noted that money from banks, loans, is kind of the cheapest money, or the cheapest money that you can get. But I think what I'd like to know is an example loan, say $300,000, and give us maybe an average term,
What's the money going to be used for?
Okay, maybe you can just come up with one. I just want to know, what I want to know is what is the payment term, lifetime, how soon do they have to start paying? And if everything goes south, what do they lose? 'Cause that's really trying to understand what the cost of the money is. Because if you have an investment-based, say an angel funded, they're giving up ownership of the company, which it's costing them a lot. But they also don't get a consequence when they go under. And so you can just explain what.
Yeah, so that is a really difficult question to answer because it really depends. It depends on what is the money going to be used for, and how much do we need to borrow, and what is the collateral, or are we doing it based on general business assets? So there's
Just take an example,
the
$300,000, make up whatever their situation is, and then come back and say, okay, so-and-so has qualified, they've got $300,000, it's a 5-year loan, it's when's the first payment due, and what happens if they don't make their payments?
I can give you, I think I can give you the macro level answer you're looking for. You make payments starting the next month, and if you don't make them, they're going to take your house or whatever you've collateralized to make the loan. Yeah, it's just that simple.
So what I'm getting at is
Yeah.
cost of a loan, when everything goes well, of course, you've paid back the loan at some interest rate, you didn't have to give any ownership of the company. But the consequence in case something goes really bad is huge.
Yeah.
So on the home equity side, if we were going to fund it with the home equity, we're looking at rates somewhere between, it depends on debt to income, loan to value, and credit. So there's a few factors in there. But the rates could be anywhere from, let's say 7.25% to 9% roughly currently. And if you don't pay that loan back, the bank takes your house.
Yeah, and I think too, this kind of went to one of the questions earlier about, do you set it up as a personal or do you set it up as a business? I mean, I think you have to talk to your accountant and hopefully an attorney to advise, and some of this may depend on what your personal assets are and how much you want to really risk around putting those personal assets at stake. And so I think having an accountant and attorney on your side when you're starting to make those decisions are really important so that you're not exposing yourself to liability. But you said something, Yana, I want to kind of dig into is, are the rates and terms dependent on, when you say it depends on what kind of business it is, are the rates and terms dependent on industry, or are they dependent on, type of collateral? Because, when you say it depends on what kind of business it is, what does that mean?
Yes, type of collateral for the business. So if customer A wants to buy $300,000 worth of exporting trailers or whatnot, that's different from, then we would ask, what is he going to hold as collateral? Business, real estate, just the trailers, or home, personal residence maybe. I'm not sure. Investment properties. That's all going to be taken into account and go into the risk, right? If customer B wants to just purchase a real estate and get $300,000 out of their current primary residence, which they own free and clear, or they want to come to me for a commercial loan and go, can you do that? And I'm going to go, well, yeah. What is it? It's a fourplex. I'm going to buy it. I just need $300,000 to buy it. I'm going to put the rest up. Okay, well, that's her. She gave you her rate for the home equity line, fixed or not, I'm not sure, but I would go fixed, commercial, real estate, non-owner occupied, and give them a rate that's a little bit higher than an owner occupied, but it would be 6.5 to 7, somewhere in that area, give or take. Don't quote me on that one, but it changes daily, right? So. I would think that, and then the payment the payment's a little bit different, right? It would start in 30 to 45 days, depending when you signed. You would then have the choice, because a commercial loan is a little bit different than a residential commercial loan, residential consumer loan, excuse me. You would have to pick between, typically it's 25-year term. Multifamily, sometimes we can get an exception out to 30, but really there's going to be typically there's a 10-year balloon with a one-time 5-year reprice in the middle. So most customers probably don't know this, but you get to pick between 3, 5, 7, or 10 years. We just always choose for you, which typically 5-year runs the most bang for your buck, right? So lowest rate. But then it's going to reprice in 5 years, and then it's going, at 10 years there's a balloon, so you're going to have to redo the loan again if it's not SBA or anything else, right? So it really just depends personally what risk you want to take and what your CPA says. How did your business strategist, your attorney, and your CPA put it? Are they putting it in an LLC? Are they putting your business in a trust that the LLC owns? I mean, what tax strategy are you using?
It seems like a really good situation would be if you have a business that has its own assets that you can put up as collateral, and that you're an LLC, so you're protecting your personal assets. It seems like, now, maybe not all companies are in that situation, not all founders are in that situation, but would that be something you'd recommend, or does that look good?
They're not all in that situation, but it looks way better. If you have some type of asset that the bank can hold as collateral for your loan, then sometimes that's how I get around my bank not wanting to do a startup. They have enough global income and a different type of asset that we can hold as collateral and securitize it, so then we give you the money for your startup. So, but it really just depends, again, collateral type and risk.
And what's different about the home equity versus the commercial loan is it's amortized over, if you're doing a loan, it's amortized over the term that you want. So you could do 5 years, 10 years, 15, up to 30 years on the home equity. And there's no balloon payment. There's no repricing after 5 years. It's that fixed term for the length of the loan.
I want to ask a question about, because this is kind of what we're pointing toward, is that, it seems easier to get a loan for something that can be collateralized, if that's a word, versus like working capital.
100%.
So when so now let's move the conversation away from those loans that have collateral attached, and let's move into a little bit about what does a term look like for just working capital. To give somebody some runway, and maybe not have all those things attached. Is that fundable from the banks? And then Eric, I'd like for you to weigh in kind of on the SBA with some of the lenders that you work with in that capacity. So working capital loans, what does that look like?
You go.
Okay, so working
you made
capital
me go
loans.
first a lot.
I didn't sit there. So working capital loans, I guess it depends on the type of business, right? So not just the collateral, but is it the RVs that are going overseas? Is it bookkeeping? Is it consulting? The nurses, right? So if it's a small ask, the easiest route to get it overnight is always going to be that personal credit card or that personal loan, the personal line of credit, taking cash out on some asset, whether it's a vehicle or home equity line on a home. That's always the easiest. I've never seen a business loan, unless maybe like a business credit card, I guess, but that's funded same day or next day, like the personal. So I would just say it really just depends on our appetite for whatever type of business you have. Like, what's the risk, and do we want to lend to it? But you're looking at 4 to 6 weeks for your typical loan. So
we actually have a really great loan program that we call the Quick Loan, and it can be unsecured. It could be secured with general business assets or with something specific, a vehicle loan or something like that. But it can be unsecured up to $50,000. So there is potential for that. Time in business could actually be 6 months. And we would do SBA backing with that. So there is potential for that, but we're typically looking for 2 to 3 years time in business for that kind of a loan.
What was the question again?
Just when we talk about unsecured loans,
just in my experience, it's really hard to get those, right? But the cases where we have, had success in that area, they're really looking heavily on the secondary income.
Mm-hmm.
Yep.
And I'm guessing too that's where the founder's credit score becomes more and more important. One more. We'll get, yeah.
Oh,
Go
I was
ahead.
saying, I will add that a lot of times I send them over to Mike Dang, Stacy Sanchez's, the guy that took over for the CDC, because they'll do somewhere between, what is it, like 50 to 350,000, right? And you don't need a bank to deal with them. You can just deal with them directly. Angel investors. Sometimes I have a list of hard money lenders, and I send all three ideas over by email, and I give my clients the choice. Like, I can't do anything for you, but these are the three options. And then business credit cards, U.S. Bank, Capital One, Chase, depending on their credit profile.
Yeah. Okay, Mary, you have a question.
Now, what if you have standing purchase orders and you want like line of credit or funding for inventory? What's the best route for that?
Well, I mean, I'm sure these guys have maybe they have products that are geared towards that. We have accounts receivable financing that I work with Marble Bridge. They're out of the Bay Area. Andrew Crone is a really good partner with the SBDC and has been for 30 years. But that's his lane. Okay, you have contracts, the money's there, you just don't have it yet, right? And they help fund that stage. And so that's specifically what that lender does.
U.S. Bank does also have a program to lend on accounts receivable as well.
We do too. If you're too new and you're a startup, then we're just going to advise that we work with SBA or California Capital, something like that. Otherwise, sometimes we refer you over to, if you need the money right away, a lender that can do it pretty quickly, like U.S. Bank, or we'll warn you if we think you're a fit that it's going to take normal underwriting like 4 to 6 weeks, but most banks can definitely do it.
And Mike is saying that we can do it on inventory, so inventory and accounts receivable.
In that way, then inventory is the collateral, right? You default, that the bank's coming after your inventory.
Well, I'd love to learn
Yeah.
more about that.
What's that?
I'd love to learn more about that,
Yeah.
for sure.
Okay. Do you want to say more about that, or no? Okay. Okay, good stuff.
Wait, I'll say one thing for him. So it's based. Typically, it's, and I won't speak for Mike, but typically it's, and we'll do the same. But it's we'll put a broad UCC filing over everything. So we hold that as collateral. So if something happens to that business, we have first right to collect on it. So.
Okay, for the audience here, how many of you really feel intimidated about conversations around financials? Is everybody in this room pretty comfortable with those conversations?
It goes back and forth.
Yeah.
Because there's parts that are scary. I mean, it's just like buying a house, right? It's like the biggest purchase, but then the flip side, you know? But I think anytime that you have to bring everything to the table and talk money, I think for some, you know, if that's where you do get, oh my gosh, this is real, you know? But at the flip side, you've got the growth on the other side.
Anybody else feel intimidated by financial conversations? Okay, good. Thank you. Yeah, let's be vulnerable. So what advice for the folks in the room who have said that they feel little intimidated by financial conversations, what advice would you give to them on how to get more comfortable? Eric, we'll start with you.
Well, I don't know. I mean, I really think it's just about practice and consistency. And so if you don't know anything about accounting, then maybe access some of our free learning resources until you know a little bit about it. I can help walk you through things, and some people learn better that way, but to me, it's just about practice. Or it's about passing that responsibility to somebody else who that's their business and that's what they do, right? You wear the hat of whatever your business is. At the beginning, or if you're a solopreneur, you're expected to wear every hat, right? But eventually, if you have the income, let's pass those hats out, build a team, or just pay to have that service done by somebody else.
Yeah, you are the expert in your business, so go talk to your banker because they know a lot about finance and they can help you with those things. So I'll just go back to build that relationship with your banker. It's a great place to go.
So I agree with that. That's the first place. Second is build your relationship with the SBDC or their counterpart in your area. Really what you're looking for is you want to be the expert in your business. You want to know for that consulting or that app, what do you need? How much do you need? Are you risky to the banks? Are you not? And then, you want to know what the ask is. Like, are you just looking for $25,000? That might be a micro lending. And there might be a dozen other institutions or other places in California that will lend to you for $25,000 or less, and maybe not even a bank. So,
I want to just say here too that AI is your best friend. A year ago, I would have said Google's your best friend. It still is, but it's Gemini now. But I will say too that if you are preparing for a conversation, at this point in your journey, you are living, eating, and breathing. And I'm looking at some of the folks I know that we've been working with for a while. I mean, this is all you're thinking about, probably all the time. And it's just a quick little, line in the search bar. And you'll get a good enough response, I think, too, to start to feel more comfortable with terms. And I'm a big believer in fake it until you make it. When you have a trusted relationship with a banker, or somebody kind of in that industry, feel empowered enough or vulnerable enough to have those conversations and ask those questions. But if it's late at night or in the middle of the night and nobody's available and something pops into your head, I mean, really prepare yourself with the resources that are available online. I think that these types of sessions are obviously amazing because we're putting them on. But it really does give us a chance to be in relationship and to ask questions and have dialogue. But really, there's just a tremendous amount of information available within seconds when it comes to these conversations. And so if you feel intimidated, if you feel like you don't know enough or that you want to learn more, that information is available immediately. And if you have a question, just, ask. Yano.
I was wondering if a company's small business's CPA would be helpful or not in this issue. Are they too much tax, not enough understand lending, or what? It's on the CPA.
I have one CPA in mind. She's always great. Goes in the gray area for you, steps her toe in, not the whole foot, right? But she'll go in the gray area and go to bat for you, and when strategizing for your business. But there's others that just say, okay, well, what did you do last year? Fill out the booklet, give me your receipts, and thank you. I'll see you next year.
Okay. Oh, go ahead, Eric. Yeah. Okay. Tristan, anything to add there?
Can I add something?
Please.
So, for the folks that are nervous about it, I understand it, but if you're nervous and you're dealing with your banker, being transparent, just saying, look, I don't understand what we're talking about, or I want to do this down the future, be honest with them. Don't try to make things up or just nod your head, because then you're going to leave and you're not going to know what to do, right?
Yeah.
So when you're with your banker, if you have a good enough relationship with your banker, they either have the tools, they know how to teach you, or they know where to put you at, right? I think that's the biggest thing when it comes into it, and that's the vulnerability that you're talking about, just being honest. I mean, I'll tell you, as a banker, I've asked questions to business owners, and they're like, why do you need to know all that stuff? And I'm like, well, you go to the doctors, do you just walk in and not say a word? Right? You don't, right? So the thing is you have to earn that. And, I had a leader a long time ago said, if you have a business, you should have your banker, your attorney, and your CPA, and your phone number right away, and you should be able to give them whatever that you need. But just being open and transparent and really just being honest. Hey, I don't understand this. Can you teach this to me? Or, hey, I need help with this. Do you know somebody? I mean, we work together. I mean, if I can't do something, I call Shafay all the time. Vice versa. I mean, it's just what we do and working with other departments. So.
Yeah,
I appreciate that. Thank you.
Networking is another thing. If you just leave here with this tonight, right? Like your spheres of influence, centers of influence. Everybody calls it something different. But your CPA, your attorney, your lawyer, right? All these people they're part of your team, whether you're paying them or not. That's a different story. But if you come to enough of these networking things, you'll have friends that are in those centers of influence, and then you can hit them up with an email and not spend $1,200 just to ask them a question about something.
Also, too, I want to talk about transparency, and then we're going to wrap it up with one final question. But I also think, too, that when you talk about having those trusted advisors, how important it is to share kind of what you're, if you're going through something rough or you're going through a difficult time, you should absolutely let your banker know, because then it becomes a one-off and not a pattern of behavior. So I think that transparency at the start, and then transparency throughout the relationship is really important, because there are tools that banks have, or if you have an opportunity to connect with SBDC, if you have hit a rough period in your business, my banker would be the first person that I would call, because they may have some tools to help me get through that if it's a financial kind of support need. So, and SBDC, I think with SBA loans also have some tools to use there. So just want to underscore that transparency piece, and also that piece that you would actually share kind of what's going on with somebody, because there are resources available. Okay, we're going to wrap it up with just, if somebody in this room wants to be fundable in the next 12 months, what are the top 2 things that they need to be doing today?
Take care of your credit and make sure that that is a top priority, and pay attention to your cash flow and your capital, and be building that capital to help come to the table.
I work with the SBDC. Make sure you have a business plan and projections.
Okay. Yep. Come work with me, and we'll just start working on all that stuff. But I mean, honestly, it's just like, tighten everything up, save as much as you can. Try not to burn through everything, because we don't want to wait until we're at 0 to ask for money, because that doesn't work either. And stay away from merchant cash advances. Merchant cash advances are the emails that you get sent that say, hey, I'll give you $38,000 tomorrow, right? There's nothing good about them. You can't refinance them through SBA products anymore. They're predatory. Most of the time the interest rates are in the 150%, I mean, they're all over the place. And if you pay it off early, who cares? You still owe all that. So really, if it's easy to get the money, it's not a good way to get it, okay? So talk to somebody else first.
I have one quick question. Just because recently I learned the difference between a credit card and a charge card, and how it affects your credit differently. Will you guys go into that to learn a little bit better?
I'm actually not familiar with the difference at all. I'm not sure.
Is a charge card just with like one store or something?
Apparently, a charge, if you have a credit card, it doesn't affect your credit like a charge card does.
Are you saying like a store card on the personal level, or like a Amex where you have to pay it off monthly?
I think so. So my sister is a loan officer, and she started to explain it to me, and I said, you mean like a debit card, and she's like, no, a charge card versus a credit card. I thought they were the same thing.
I looked it up. Charge card is a payment card, requires you to pay your balance in full every month.
So that's like
An Amex.
That's like Amex, yep, Diners Club International. So basically, you're paying off whatever that is every month. There's no bill that's left over, whereas you're just getting your FICO scores going off of the minimum payment on that you're paying off the credit, and kind of how we look at it too. So it's just like the Amex, or like if you have a gas card through, I don't know, through that or whatever other fuel cards there are, you usually have to pay them off monthly.
So you want a credit card, not a charge card.
Yeah, because the credit card is that revolving line of credit that you're going to be able to carry a balance and have payment history on month over month, versus the charge card, where you have to pay it
The
off.
charge card doesn't necessarily look bad, but I don't think they report the same way as what your sister was trying to tell you. And I don't know the difference about how they report, because I haven't ran across. We don't do charge cards, and I only see them in the fuel industry really anymore.
Yeah, I just recently learned this. I thought they were the same thing. For
Yeah.
credit, as far as
Yeah.
affecting credit.
Okay, so these guys are going to stick around for just a few more minutes. I don't know.